Welcome back. If you're new here, this channel filters for independent thinkers. If you need guarantees and excitement, you'll be disappointed here. We analyze system stress in precious metals markets, specifically the fracture between paper promises and physical reality. My name is James. This is your James Agee. Before we touch today's development, and it is significant, I need to cover non-negotiables. There are impersonators operating right now using my name, my avatar, my exact phrasing in DMs. They will promise you exclusive signals, VIP access, managed accounts. They are criminals. I will never ask you for money. I do not have a paid group. I do not manage capital. I do not send direct messages soliciting anything. If someone messages you claiming to be me, block immediately. Report the account. This is not optional housekeeping. This is community protection. The scammers know this channel discusses volatile markets. They prey on that urgency. Do not engage. Second, I am not a financial advisor. Nothing here is investment advice. I am a macro analyst documenting market structure, policy signals, and supply chain mechanics. You are responsible for your own decisions, your own due diligence, your own risk management. I do not know your situation. I cannot know your situation. Treat everything here as starting point for your own verification, not endpoint for action. For the returning community, yes, I see you. The OGs who've been here through the range-bound grind, the paper raids, the futures games. Drop your location in comments. I read them. It matters because what we're tracking today has geographic implications. Where you sit relative to these flows, Shanghai, London, New York, the physical hubs changes what you witness. The Asian session tells a different story than the COMEX close. Your location is context. Audience filtering time. This video will frustrate certain viewers. If you want price targets with countdown clocks, exit now. If you want moon predictions and leverage strategies, this is the wrong channel. Today's topic involves policy mechanics, inventory anomalies, and delivery psychology. It requires patience. It requires sitting with uncertainty. The traders who need certainty every 12 hours will hate this. The stackers who understand multi-year positioning will recognize the signal. Know which one you are. The catalyst. Vice President J.D. Vance, meeting with over 50 countries, announced the United States will establish a price floor system for critical minerals. Silver is classified as critical. The mechanism involves preferential trading blocks, adjustable tariffs, countering market distortions, primarily Chinese supply dominance. This is not commodity support from the 1970s. This is national security architecture. And if the floor lands above current paper pricing, which the transcript suggests could be around $86, we are not talking about a rally. We are talking about forced repricing. The state becomes marginal buyer of last resort. That is the frame. That is why the cheap silver era, defined by paper markets setting prices below replacement cost, is potentially ending. Not through market discovery, through policy intervention that recognizes silver as strategic input, not speculative toy. Price floor discussions around $86. Strategic petroleum reserve comparisons. These numbers are circulating because they represent a magnitude shift, a policy recognition that current pricing fails to secure domestic supply chains. I mentioned them briefly, only to establish why this development commands attention. But numbers without context are noise. The dislocation is the signal. Here is one current abnormality. Last 30 days, COMEX registered silver inventory fell approximately 12%, while paper price remained range-bound between $29 and $32. Registered inventory, the metal immediately available for delivery against futures contracts, dropped from roughly 151 million ounces to under 133 million ounces. The paper price registered this as sideways boredom. The physical market registered this as accelerating scarcity. This is not normal. In functional markets, sustained inventory draws correlate with price appreciation. The disconnect reveals a structural fracture. The futures market is trading claims. The warehouse is emptying. Someone actually, multiple someones, is standing for delivery and removing metal from the deliverable pool faster than new registrations replenish it. The first 4 days of February crystallized this. 2,955 delivery notices issued against the February contract. January end open interest for that same contract, 1,231. Basic math fails unless new longs entered specifically to take immediate delivery in a non-primary month. This is not rolling positions. This is physical accumulation bypassing the paper game entirely. 2 consecutive months of this pattern. Relentless, systematic. East Asian physical buyers operating during hours when Western paper markets sleep. The intraday mechanics confirm the split. Asian and European sessions. Silver rallies on genuine physical demand. Price discovery reflecting tight supply. New York opens. Algorithmic selling. Futures-driven reversals. February 3rd and 4th both saw silver rejected at approximately $90 in overnight trading, followed by 8 to 9% collapses during U.S. hours down to $83 before partial recovery to $86. Gold experienced parallel volatility. The pattern repeats because the underlying conditions persist. The paper price says $30 or $32, or whatever the futures screen displays. The physical market says not available at that price. That is the dislocation. That is the story. The policy announcement from Vance does not create this tension. It recognizes it. It signals that Washington sees the same fracture we document here. A pricing mechanism failing to secure strategic supply. I want to be precise about what this means and does not mean. It does not mean immediate price explosion. It does not mean the paper market collapses tomorrow. It means the range of acceptable policy outcomes has shifted. The U.S. government is now on record that current pricing may be too low to ensure domestic production viability. When the state enters as price floor architect, the volatility distribution changes. Downside becomes politically managed. Upside becomes strategically necessary. The numbers to watch are not price targets. They are inventory velocity, delivery notice concentration, and the spread between future settlement and physical procurement cost. These metrics are deteriorating in synchronized fashion. That synchronization is the event, not the headline, the mechanics underneath. Current registered silver, approximately 133 million ounces, down from 151 million 30 days prior, down from 180 million 6 months ago. The trend is not flattening, it is steepening. Critical distinction. Registered means available for immediate delivery against futures contracts. Eligible means stored in COMEX-approved vaults, but not currently offered for delivery, often long-term holdings, ETF backing, or sovereign stockpiles. The registered pool is the pressure valve. When it shrinks, delivery risk concentrates. The registered to eligible ratio has collapsed from roughly 45% to 28% in 12 months. This is not rotation between categories. This is metal leaving the deliverable system entirely, exiting through delivery notices, moving to private vaults, flowing east. Once registered silver is delivered and removed from COMEX jurisdiction, it does not return easily. The pipeline is one way. What registered actually means, a promise backed by a specific bar with a serial number. When that bar leaves, the promise becomes a claim on future production, existing inventory elsewhere, or cash settlement. The futures market is designed to absorb some delivery stress through cash settlement mechanisms. But those mechanisms assume sufficient physical exists to cap extremes. The data says that assumption is weakening. The Shanghai silver premium over London spot has remained elevated for months. In efficient markets, arbitrage closes these gaps. Metal flows to where price is highest. Premiums compress. Equilibrium restores. This is not happening. Why arbitrage is not closing? Because the metal flowing east is not returning. Chinese solar panel production, Indian industrial fabrication, strategic stockpiling. Demand is inelastic and immediate. The premium signals not temporary scarcity, but structural deficit. Western warehouses empty, Eastern vaults fill. The price divergence persists because the underlying flow is strategic, not speculative. Direction of metal flow determines price discovery location. Historically, London and COMEX set global silver pricing. As physical dominance shifts east, that pricing authority fractures. The Vance announcement recognizes this fracture explicitly. U.S. policy now aimed at reclaiming domestic supply security, precisely because market pricing failed to ensure it. Latest CFTC commitment of traders. Commercial net short in silver at historically concentrated levels. The commercial category, swap dealers, bullion banks, market makers, holds massive short exposure against rising physical tightness. Brief historical context. Similar concentrations preceded volatile periods in 2008 and 2011. Those episodes resolved with sharp price adjustments as covering requirements met limited available liquidity. The risk. If physical delivery pressure forces commercial short covering, the mechanism becomes self-reinforcing. Higher prices trigger margin requirements, which trigger more covering, which exhausts registered inventory faster. The paper market is levered to physical availability. When that availability contracts, the leverage becomes dangerous. 3 data points. Inventory velocity eastward. Premium persistence despite arbitrage incentives. Commercial exposure against contracting supply. They do not contradict, they amplify. The paper pricing mechanism assumes physical elasticity. The physical market is demonstrating inelasticity. Policy is now intervening to acknowledge that mismatch. RSI context. Daily silver RSI peaked above 75 during the February 3rd overnight session, extreme overbought territory. The subsequent 8% reversal during New York hours corrected this to mid-50s, neutral territory. Weekly RSI remains elevated near 65, suggesting underlying momentum persists despite intraday volatility. The divergence between daily exhaustion and weekly strength indicates a market being pulled between timeframes. Short-term profit-taking against longer-term accumulation. Moving averages. Price currently trades between the 50-week moving average, near $28, and the 200-week, near $22. This is wide band consolidation, not trending structure. The rejection at $90 in overnight markets, paper price equivalent $32 area, occurred far above both averages, an outlier event driven by thin liquidity, not sustainable momentum. The 50-week slope remains gently positive. The 200-week continues ascending from 2020 lows. Neither suggests bearish macro structure. Neither confirms breakout. Volume profile. The highest volume node sits at $28 to $30, established through months of range-bound accumulation. Above $32, volume thins dramatically, an air pocket. This explains the speed of overnight rallies and subsequent collapses. There is no sustained participation at higher levels yet. The market can spike through thin air, but cannot hold without volume confirmation. Each $90 equivalent spike has retraced to the high volume node. Until volume builds above $35, these remain liquidity hunts, not breakouts. Why technicals matter in manipulated markets. I do not trade these levels. I watch them to understand where algorithms will create liquidity or engineered volatility. The paper market is not a price discovery mechanism in the traditional sense. It is a liquidity management system for derivatives. Technical levels mark where that system activates: stop hunts, margin calls, option expiries. When I note RSI extremes or volume gaps, I am mapping where the machinery will likely trigger, not where value resides. The technical snapshot serves one purpose: timing awareness. Physical holders need not watch 4-hour RSI, but understanding that paper markets generate volatility at specific technical junctures helps explain why overnight spikes collapse at COMEX Open. It is not random. It is algorithmic. The machines respond to levels that human traders no longer dominate. Knowing this does not predict price. It predicts behavior. Recessionary industrial demand collapse. Silver remains 50% plus industrial metal. Solar, electronics, automotive applications drive consumption. A synchronized global recession. China property contagion spreading. U.S. manufacturing contraction deepening. European stagnation persisting. Could crush fabrication demand faster than investment demand rises. ETF outflows, already record in Chinese gold vehicles, could extend to Western silver products. The safe haven bid is not automatic. 2008 saw silver cut in half during the initial deflationary shock before monetary response revived it. Dollar strength, DXY. The dollar index near 105 with momentum higher creates headwinds. A funding crisis abroad, Japanese yen carry trade unwinds, or European banking stress triggers dollar squeeze. Silver priced in dollars becomes more expensive globally, just as credit contracts. Physical buyers delay, paper sellers accelerate. The DXY silver inverse correlation is imperfect, but persistent during stress events. Margin hikes, rule changes. COMEX management has tools. Increased margin requirements for silver futures raise cost of carrying positions, forcing liquidation regardless of conviction. Position limits could cap concentrated longs standing for delivery. Cash settlement rules could be modified to market disruption events. The exchange exists to manage systemic risk, not facilitate price discovery that threatens member solvency. Volatility and profit taking. 8 to 9% intraday swings destroy leverage. Traders forced out by margin calls do not return immediately. Long-term holders seeing unrealized gains evaporate may lock in profits, adding supply to thin markets. Volatility is not inherently bullish. It is attrition. What invalidates the thesis? Sustained COMEX registered inventory rebuild concurrent with rising prices. Shanghai premium compression to zero. Commercial short covering without price disruption, or policy abandonment of the price floor framework. Any of these developments demand reassessment. Recessionary safe haven bid. 2008 proved the template. Initial liquidation gives way to monetary panic. Central banks cut rates, expand balance sheets, debase currency units. Silver's historical role reasserts when faith in fiat contracts. The recession bearish case assumes no policy response. That assumption fails against current demonstrated behavior. Gold buying at historic central bank pace, U.S. price floor proposals, geopolitical escalation canceling Iran nuclear talks. Recessions trigger interventions. Interventions drive monetary metals. Dollar strength equals temporary. DXY rallies are crisis liquidity squeezes, not structural appreciation. They resolve through swap lines, QE, or coordinated intervention. The dollar's reserve status requires supplying liquidity globally. Sustained strength destroys emerging markets and rebounds as credit risk. Silver's dollar price is a derivative of this cycle. The underlying metal stockpiles in Shanghai regardless. Inelastic industrial demand. Solar silver loadings are technological commitments. Projects in construction cannot pivot to copper. AI data centers require massive electrical infrastructure, silver dense for reliability. These are decade-long capital commitments, not discretionary purchases. Demand destruction requires project cancellation, not delay. The installed base grows regardless of quarterly GDP prints. Signal convergence. Inventory drain, premium persistence, policy recognition, and commercial positioning all align. No single indicator contradicts the others. Bearish cases are delays, not invalidations. The structural supply deficit doesn't care about quarterly GDP prints. Physical holders. You purchased metal to avoid system dependency. Checking daily prices contradicts that purpose. The $86 floor policy, if enacted, changes your insurance valuation over years, not hours. Your action is storage verification, not price monitoring. Ensure your vaulting is secure, your records are current, your beneficiaries know locations. The market will scream for months. You do not need to listen. Traders. You operate in a market where 8 to 9% intraday reversals are standard deviations, not anomalies. If you lack position sizing discipline, stop-loss protocols, and psychological preparation for 10% drawdowns, you are gambling. The structural bullish case does not prevent short-term destruction. Leverage in this environment is Russian roulette with 3 chambers loaded. Trade the volatility. Do not marry the conviction. New stackers. You entered during noise. Good. Noise creates entry points. Start with physical allocation, coins, bars, direct possession, or allocated vaulting. Avoid ETFs promising exposure without delivery rights. Learn the spread between spot and physical before you buy. Your timeline is decades. Your education starts with understanding what you actually own. Know which one you are. Physical holders checking daily prices are masochists. Traders holding through 10% drawdowns are gamblers. Pick a lane. 3 takeaways. First, the paper versus physical disconnect is measurable and widening. COMEX registered inventory down 12% in 30 days. Shanghai premiums persist. Delivery notices exceed open interest. These are not narratives, they are ledger entries. Second, the viral memo referencing $86 price floors and strategic petroleum reserve parallels. Its authenticity remains uncertain. The structural stress it describes is independently verified through inventory, premium, and positioning data. Policy confirms the condition, even if specific numbers remain speculative. Third, an 8 to 12-month window for structural resolution, not price targets, system resolution. Either delivery mechanics adapt to scarcity, or scarcity forces mechanical price discovery. One unresolved question: will COMEX change delivery rules before physical supply breaks? Cash settlement mandates, position limits, force majeure declarations? Or will we see the first true price discovery in decades, when paper claims meet empty warehouses without policy intervention? Verify everything I have presented: independent sources, official data, your own logic. This channel provides framing, not certainty. Invest with logic, not hype.